The decade following World War I was nicknamed the Roaring Twenties to characterize the social and economic windfall spreading across the nation. The term, however, was misleading, as many ominous signs pointed to trouble on the horizon. Not everyone was celebrating and basking in success. Farmers and mining, steel and textile industries were all suffering their own depression. Their plight foretold the trouble ahead for the entire nation. It's now time for a little economics lesson. Over long periods of time, the economy follows a natural ebb and flow known as the business cycle. This is like life. There are ups and there are downs. When the economy reaches its highest point, this is known as the peak. The only way to recognize the peak is when a recession occurs, meaning that the economy is starting to slow down. If a recession continues to worsen, it could lead to a depression. This is marked by high unemployment. When a nation's economy begins to improve from a recession or depression, this is known as expansion. The U.S. has been suffering a recession for several years. There are moments of improvement and decline. The best way to look and understand the business cycle is over long periods of time. There are events that can impact the natural flow of the business cycle. For the U.S., World War I led to an economic boom as overseas demand for U.S. goods skyrocketed. Businesses and farmers were urged to increase production capacity and output. When the war ended, demand dropped significantly. While some industries suffered immediately, many were saved by the new purchasing methods and the emergence of leisure time. Americans' optimistic outlook and careless spending helped conceal the onset of a nationwide recession. While the rise and decline of the business cycle is natural, there are many factors that were present in the 1920s that contributed to the fall of the economy. New spending practices, return to laissez-faire government policies, and unstable social and economic structure all led to the collapse of the economy. Following World War I, there was a change in American buying habits. Instead of buying only what one could pay in cash, people began to buy on credit. This meant Americans were obtaining a good and paying for the balance at a later time. Cars and homes were often purchased with installment payments, meaning a person would pay a fixed amount each month until the loan was paid off. Credit cards also were becoming a popular way of spending. The overspending led to a false sense of prosperity in the U.S. as Americans bought and lived beyond their means. As debt accumulated, many had difficulty making the minimum monthly payments. This led to a slow in buying and contributed to the underconsumption trend. While some parts of the economy were slowing, many others were booming. The positive outlook on American wealth and spending led companies to amp up production. As Americans reached their debt limits, spending slowed. This led to a gap in the amount of goods companies produced and the amount of goods Americans demanded. The result was a surplus. By 1929, company warehouses were filled with excess goods. As a result, they decreased production and began to lay off workers. The industries that had not struggled in the 1920s now began to slow as sales dropped. During the 1920s, over 6,000 banks closed their doors. Many of these banks had loaned people's savings to farmers to purchase new equipment and expand production to meet the growing demand of World War I. After the war ended, demand plummeted along with crop prices. Thousands of farmers lost their land and were unable to pay back loans, resulting in the closing of rural banks across the country. The presidents of the 1920s, Harding, Coolidge, and Hoover, took a pro-business stance. Through low taxes, expansion of credit, and very little government regulation, the presidents hoped to boost industry as a means to grow the economy. The result was a system that went unchecked and overexpanded beyond the abilities of the economy. The hands-off attitude of the government and the live for today attitude of Americans was setting the stage for the collapse of the economy. Between 1920 to 1929, the rich got richer and the poor got poorer. More than 70% of Americans lived below the poverty line. The accumulation of debt with credit purchases only made matters worse. The economy became more dependent on the spending of the wealthy few. The shift from economic slowdown and looming recession spiraled into a Great Depression with the collapse of the stock market in 1929. This is considered the immediate cause to the Great Depression. As the economy began its natural slowdown, the shady business practices of playing the stock market were about to add fuel to the fire. During the 1920s, inflated company earnings, speculation, and buying on margin created a fragile market system. The collapse would come on October 29, 1929, known as Black Tuesday. Post-World War I America returned to conservative business practices. Little attention was paid to what corporations were doing. Unchecked, companies inflated earnings. Let's take a look at the picture on the left. If Company A sold all its assets, it would be worth $6 million. Without regulations or interference, Company A sold $10 million worth of stock. This meant that if every stockholder cashed in their shares, only 60% could actually be paid back. The gap in earnings and stock sales was first recognized by professional speculators. Speculators were people who made risky investments to try to get rich quick. These were the first people to start to pull out of the stock market in 1929. Between 1925 to 1929, securities, or stocks and bonds, more than tripled on the New York Stock Exchange. The system of purchasing stocks was a fragile house of cards, dependent upon stocks being sold higher than what they were purchased for. The practice of buying on margin meant that investors could buy stock with only a small down payment. Usually this was about 25% of the cost. The rest of the money was borrowed from the bank. Think about where banks get their money from. When a person deposits money into a savings account, the bank keeps a small portion and then lends out the rest. The system is dependent on borrowers to pay the money back with interest. When the stock market collapsed, stocks were worth only a fraction of their original cost. Loans could not be paid back, and depositors were forced to pay the price. In 1929, the stock market started to decline. Stocks were overpriced compared to the company's earnings and profits. By the end of 1929, stockholders and banks had loaned out $17 billion. The Federal Reserve warned banks not to loan money for risky ventures, but the spirit and sunny outlook blinded people from the dangers that were brewing. In September 1929, professional speculators began to withdraw their investments. Prices began to drop. On October 24th, 13 million stocks were traded, causing prices to drop below the amount of money borrowed to purchase them. Brokers tried to get investors to repay, but without being able to sell their stocks, they were unable to pay back their loans. To fix the problem, some banks tried to avoid a crash by buying as many stocks as possible, which wasted more of people's savings entrusted to the bank. On October 29th, 16 million stocks were sold, causing the collapse. By mid-November, securities were cut in half. While only 3% of Americans were actually involved in the stock market, the banking crisis that followed would drag millions more into the crisis. After the collapse, many people panicked and pulled their money out of banks. More people ran to try to recover their savings. The run on banks caused thousands of branches across the country to close their doors. Millions of Americans lost their life savings. The collapse of the stock market drove the economy into an unstoppable descent. As banks closed, millions of people who never invested in the stock market lost their life savings. As spending decreased, more businesses laid off workers. Spending decreased again, and the cycle continued. Many Americans lost their homes and joined the tens of thousands of homeless people across the country. Makeshift neighborhoods known as shanty towns, made of scrap metal, began to pop up everywhere. To help poor Americans, cities scrambled to provide what little relief they could by opening soup kitchens and bread distribution. Unemployed men would wait hours in line for a handout and a way to feed their families. The nationwide crisis begged for government intervention. Americans' eyes and ears turned to President Herbert Hoover.